Welcome to part 2 of the Beginner's Lounge. Before we begin this session, we would highly encourage that you view the Beginner's Lounge part 1 first if you have not done yet. So let's begin. In today's session, we'll be talking about Contract for Difference, otherwise known as CFD, Margin Facility, Multicurrency Facility, Risk Management Diversification, Trading Capital, and difference between trading and investment. Contract for Difference, or CFD, is a facility that traders may request from their brokerage. CFD is a financial contract that pays the differences in the settlement price between the open and closing trades. Instead of paying for the total cost of the traded amount, the trader will only pay or get paid the difference between the buy price and the selling price. In return, the brokerage will require the trader to put up a small amount of cash as collateral. CFD essentially allows traders to trade a huge amount of stocks without the need for large capital. Some brokerages such as IG, Ovender, and CMC are CFD-only brokerages. CFD are not recommended for beginners as it is considered a highly specialized product due to the risk involved. As traders are not required to put up the capital for the trade amount, the trader may lose more than the cash he has available. Commission for CFD accounts are high. CFD account also charges a holding fee for as long as you are holding your stocks. This holding fee is an additional cost that is only specific to CFD accounts. Due to its complicated nature, Singapore brokerages do not come with a CFD facility unless the client specifically requests for it. CFD accounts are one of the few ways that a trader can short sell a stock. Beginners are not encouraged to use a CFD facility until they've understood the basics of stock trading. Hence, we will not be covering CFD in the Beginner's Lounge videos. Margin facility allows traders to borrow money from the broker to purchase an asset. Margin trading refers to the practice of using borrowed funds from a broker to trade a financial asset which forms the collateral for the loan from the broker. As such, traders are required to pay the interest rate on the amount borrowed. One may think of it as purchasing a $1 million property and making a down payment of $250,000. The purchaser will have to loan $750,000 and pay interest on it, and the property itself is the collateral. In this example, the purchaser is said to have 4 times leverage as he is purchasing an asset that is 4 times more than his down payment capital. Much like CFD, margin facility is considered high risk, and we do not encourage beginners to use such services until they have understood the basics of stock trading. Multi-currency facility is one of the most essential services that brokerages should offer. Financial products that are listed in foreign exchange are settled in their home currency. The multi-currency facility allows you to trade foreign shares without the need to deposit the respective currency first. If you do not have a multi-currency facility, the brokerage might charge a very high commission to convert the currency manually. Multi-currency allows traders to trade foreign shares at any time. This will come in handy if trader wishes to buy Apple from the New York Stock Exchange or Tencent from the Hong Kong Stock Exchange while maintaining a Singapore dollar base account. Tiger and Mumu, by default, will come with a multi-currency facility. If you are using Poem, you may have to apply for it. Now let us talk about risk management. There are many ways to go about applying risk management to our trading journey. One of the ways is diversification. What is diversification? It is a method in which the trader spreads his capital across different stocks of different industries to reduce risk. As much as we do not want to place all our eggs in one basket, we also do not wish to put just one egg in many baskets. Extreme under or over diversification is harmful to the trader. Under diversification is when your entire trading capital is in 5 different stocks or less. Under diversification can lead to overexposure. This means that if one of the 5 stocks performs poorly, your portfolio could be impacted heavily as you have 20% of your capital in that stock. Over-diversification is when your portfolio consists of more than 50 stocks. Having more than 50 stocks will mean that each of your positions will have very little weightage. If one of them performs tremendously well, it will have minimum impact on your portfolio. This has the opposite effect of under-diversification. You will find that your portfolio is unable to outperform the benchmark index such as the S&P 500. It is also not ideal for a trader to analyze so many stocks. Ideally, trader would want somewhere in between. The question is then, what is the optimal number of stocks a trader should hold? Do not be worried by the equation that you see here. This is the equation commonly taught in any finance program to calculate the optimal number of stocks you should hold. In Beginner's Lounge, we are going to simplify this equation for you. As we have learned, the purpose of diversification is to reduce the impact of the performance of a single stock on our total portfolio performance. On the left column of this table is the number of stocks in a given portfolio. On the right column is the standard deviation of the annual performance of the portfolio. The higher the number in this column, the more volatile it is. For example, if you have only one stock in your portfolio, your entire portfolio may go up or down by 49.24% within a year. This is too volatile, and it is not ideal for a portfolio to be this volatile. As you increase the number of stocks in your portfolio, the portfolio volatility decreases. However, there is a diminishing return. If you increase the number of stocks from 1 to 20, the volatility decreases from 49.24% to 21.68%. But if you increase the number of stocks to 50 to 400, the volatility decreases from 20.2% to 19.29%, a mere 0.91% decrement. Hence, we do not want to over-diversify beyond the optimal number of stocks. Here is our recommendation. Having less than 5 stocks in your portfolio is considered under diversification, and it is risky. Having more than 50 stocks in your portfolio will not yield any further decrease in portfolio volatility. Hence, the optimal number of stocks Nimbus Capital recommend is 8 to 20. Nimbus Capital will recommend at least 10. Let us recap and summarize what we have learned for diversification. Under diversification is having too many eggs in one basket. This will result in a very volatile portfolio that is at the mercy of a few specific stocks. Over-diversification is having just one egg in many baskets. This will result in a portfolio having a diminishing return on its volatility and is unable to outperform the market benchmark. Having a balanced approach will provide you with the optimal performance for your portfolio. How much capital do I need to start trading? Traders must be sufficiently capitalized before they begin trading. A trader must ensure they have enough capital to buy at least the number of stocks we recommended in the diversification slide. More importantly, as traders, we want to see a reasonable return for the time and effort that we put into our trade analysis. As the return is calculated upon the percentage of our capital, having a higher capital would mean a higher return. For example, a 5% return on a $5,000 trade will yield 10 times more than the $500 on the same trade. Let us assume Each successful trade requires 2 hours of analysis effort, tracking, and order management. Each winning trade will give us a return of 5% on the capital. By calculating the return in dollars, we can derive our earnings in relation to the amount of time spent. For example, if we spend only $500 on our trade will yield a $25 return. This will give us an earnings of $12.50 per hour. It is hardly an amount to be excited over. If we make the same trade with $2,000 capital, our earnings will jump to $50 per hour. Now this is an exciting amount. Of course, in trading, we will not always be profitable with every trade we take. Hence, the actual calculation will be slightly more complicated. However, the current example is sufficient for this lesson. Do recall that we will need about 10 different trades to be appropriately diversified. Therefore, the ideal capital to start trading is 2,000 multiplied by 10 positions, which equate to $20,000. We have concluded the topics for diversification and starting capital requirement for trading. In the following slides, we'll be learning about the difference between technical and fundamental knowledge, trading, and investing. Technical knowledge is understanding the price movement trend of a stock by analyzing its past price data. We will use past and current price patterns and statistical means to predict future prices. We will read the price charts by recognizing chart and candlestick patterns. Technical knowledge is widely considered to be street knowledge as it is not taught in academic school programs. Jesse Livermore is an example of a very successful trader who uses technical analysis. On the other hand, fundamental knowledge is the process of understanding the stock by using its financial earnings data such as income statements, cash flows, and earnings ratio. We make our decisions by analyzing the business model of the stock. We can predict the growth of the company, thus the stock price, by analyzing the company's financial statement. In contrast to technical knowledge, fundamental knowledge is considered by many as academic knowledge. This is because the topics regarding fundamental knowledge are often taught in universities. A good example will be Warren Buffett, a famous investor who utilizes fundamental analysis. Trading versus investment. Although both trading and investment involve buying a stock and selling it later at a higher price, that is where the similarities end. We have been using these two terms interchangeably. However, there are a few critical differences between the two. Let us talk about trading first. Trading is buying stock in the hope of catching the current price trend regardless of the underlying asset. Traders generally do not consider the nature of the business or the profitability of the company they are trading. Traders are often looking out for short-term explosive moves of the stock. Due to the short-term nature of the current price trend, traders do not hold their stocks for long. Most trades usually last a few days to months. As such, traders will utilize technical knowledge heavily as the fruits of fundamental analysis takes years to materialize. In the example on the left, we can see the hourglass price is still currently trading above the 20, 50, and 100 days moving average. As we previously saw the price supported at 50 days moving average twice, we can foresee the price to go higher in the future. In this slide, we will talk about investment. Investment is buying stock in the hope that its business growth will generate higher future earnings, which will result in stock capital appreciation and high dividend payment. Investment requires a company's business to grow. Hence, the time frame for holding the stock is exceptionally long. This is because business usually requires years to develop. Consider how long it took for companies like Amazon to be what it is today. If you are looking to invest in the company's growth, you will need to utilize fundamental knowledge to understand its income statement and balance sheets. In the example given on the left, we can see that Grand Venture has shown an increase in revenue and net profit year over year for the past 5 years. Its earnings per share have been in steady growth. We foresee this company growing even stronger in the next 10 years. Nimbus Capital's teaching focus is on technical knowledge and trading. We'll be covering investment topics in the future. The important thing for beginners is not to be afraid of taking the first step. Analysis paralysis is the enemy of every new trader. Trading is a profession in which we make decisions based on incomplete information. It is impossible for anyone, even professionals, to analyze everything perfectly before making a trade decision. Hence, risk management and diversification are essential in ensuring we are taking a calculated risk. We have come to the end of part 2. We hope that this session opens you to the world of trading and its intricacies. Do be reminded to sign up for your brokerage account, and we will see you again in part 3. Thank you for choosing Nimbus Capital.